Good day. I'm Matthew DeVette from Abax Investments. Now I'm going to chat to you today about the Nedgroup Opportunity Fund. I've entitled my presentation Rate Shock because what the market has been trying to digest for the past 18 months or so is a massive increase in interest rates. For example, in the past quarter alone, US 10-year treasuries have blown out by about 75 basis points, inflicting losses of about 5% on bond holders. Other risk assets have also been caught up in this. If you look at the S&P 500 or the MSCI World Index, or even our local stock market, all are down between 3 and 4% over the last quarter. Local bonds and local property was also negative over the quarter. So we feel comfortable with the return that we've produced over the last 3 months. We've managed to kind of tread ground, a 0% return for the Opportunity Fund over the 3 months, relative to the peer group of minus 1.4%. If you look over 1 year, it's close to a double-digit return, which is pretty much in line with our inflation plus 5 objective, but a little bit behind the peer group, probably because we've had slightly higher allocation to fixed income, which, as I've already described, hasn't been the right place to be. Over 3 and 5 years, which is our preferred measurement period, we're ahead of both our inflation plus target and the peer group. And over longer periods of time, if you look at our numbers since inception, we're pretty much in line with inflation plus 5, and we're also ahead of the peer group. So what have been the main contributors and detractors over the last year? Well, some of our core positions have contributed nicely over the last 12 months. Our banking exposure to both FirstRand and Absa have held up nicely given their conservative provisioning. Alphabet, or Google, as it's sometimes better known, was a stock that we added when the S&P wobbled in 2022. That's recovered quite nicely. And British American Tobacco, although it hasn't done much in hard currency, has benefited from the weaker rand. One of the stocks you may not be as familiar with is the Hello Group. It's actually a Chinese social media company. Got caught up in all the fear around Chinese regulation, and at one point was actually trading below the value of cash on its balance sheet. And it has since done quite well too. Of the major detractors, I'd like to highlight Thungela, which, although negative over the past year, has actually, over the past couple of years, been one of the strongest contributors to performance, although a weaker coal price and some issues at Transnet have hindered it more recently. Transaction Capital has not been a big position in the fund, but it has detracted from performance as their taxi business has run into a perfect storm post-COVID, with less people moving about, higher fuel costs, higher taxi costs, and their inability to pass that on to their commuters. So now I'd just like to chat you through a couple of slides which I think kind of encapsulate what's going on in the world at the moment and how we're looking at things. This to me is the key chart of the presentation. It's the yield on the 10-year US inflation-linked bond. If you just look at how quickly that has blown out over the last 18 months or so, from a real yield of minus 1% to plus 2.5%, that's 3.5% in just over 18 months. And again, in the last 3 months alone, another massive kick of just over 1%. So not only do real yields now look attractive relative to what we've experienced over the last number of years, but even if you compare it to the last 20 years or so, it's actually very rarely been higher than this. Now, real yields are the asset against which you must compare all other asset class valuations. And what's interesting is that although the S&P 500, for example, has certainly not performed well in the last little while, it has actually been pretty steady. And what this chart shows you is the difference between the dividend yield of the S&P 500 and the real yield available on US tips. And you can see how that gap has narrowed from somewhere between 1 and 2% more recently to a negative 0.77%. So what's effectively happened is that bonds have derated materially relative to equities. Now, from this point on, the key question, of course, is can equities continue to outperform bonds? And in order to do so, I've just kind of provided a little thought experiment on the right-hand side there, which is a very simple equation which says for the S&P 500 to outperform bonds going forward, what's going to need to happen is that they're going to have to grow earnings above inflation, and the market is going to have to re-rate or de-rate. So let's just think about those two issues. What's the likelihood of the S&P growing earnings above inflation? Well, I think this chart is an interesting one. It just shows the last 12 months rate of change of the S&P earnings growth relative to a leading indicator, which is made up of bond yields, the oil price, and the dollar. If you look at the blue line, you can see that's come off materially. It's approaching zero. And if it continues to follow the red line, it's going to go negative. So in our view, given that margins are already very high in the US, it's going to be difficult for the market to produce outsized earnings growth from this point. And in terms of the rating, we believe that's also going to be a challenge. This is quite a complicated chart, but the two lines that I'd like to point out to you are the red line and the dark green solid line. The red line is the forward PE of the S&P 500. You can see relative to its history over the last 20 years that it's elevated. It was actually only during the COVID period when a number of companies were actually making losses and pushing the PE up that it was higher. But the fair value for the market has been coming down as interest rates have gone up. So the gap between the forward PE and the fair value PE is actually pretty much as high as it's been over that period. So in our mind, as I said earlier, for the S&P 500 to outperform bonds, it's going to need to grow its earnings above inflation, and it's going to have to re-rate. Both of those seem unlikely in our view. So we think a more conservative stance with regards to our equity allocation is required. Moving back home, this is the yield on the 10-year SA government bond. It's approaching 12%. It's also kicked up more recently. You know, if you're prepared to go out in the term structure and maybe look at something like a 15-year bond, actually those annualized yields are approaching 13%. So we have a joke in the office at the moment. It's perfect for South Africans because you get your 1% a month plus a 13th check at Christmas. But given where inflation is at the moment and the likelihood that inflation remains controlled, it seems that by investing in local debt, you can earn a return of 5 or 6% above inflation, which historically is the kind of return that you've made from investing in equities, but you have much more predictable cash flows. We are the first to concede that SA bonds are not without risk at the moment. We don't consider them a risk-free asset class. Our finances are in quite a perilous state, and there is a risk down the line, although probably at the moment a remote risk, of either some kind of intervention and a haircut, or the market saying that our debt levels aren't sustainable, followed by maybe a currency blowout and some kind of higher inflation taking care of the debt load for us. So there is that risk, and to manage that risk, we limit our duration in the fund to 2 years, but given how attractive the yields are at the moment, we are currently at that limit. This is our fair value multiple for the local stock market. Again, have a look at the red line and the dark green line. The red line, if you just eyeball that, looks low relative to history, and we certainly hear a lot of commentary that, you know, based on some kind of mean reversion analysis, the SA market is very cheap. We would argue that although it is on the cheap side, it may not be as cheap as it appears because firstly, the cost of capital has gone up, which lowers the fair value multiple, but also because there's no growth in the economy and you need to adjust for that. So the SA market is on the cheap side, but it's not as cheap as it may appear just on a mean reversionary basis. So our outlook, we broadly feel that we're yet to feel the full impact of materially higher real interest rates and quantitative tightening after a period of easy money. So to us, it seems like a risky setup. We think it's a challenging backdrop for global profits in an already high margin environment. We now believe that both SA and, for the first time in many, many years, US fixed income offer attractive nominal and real returns. South African equities are cheap, but they aren't that exciting given the lack of growth and the higher cost of capital. We actually think that Chinese equities are becoming very, very interesting. The valuations on some of those businesses are extremely low. They have lots of cash on their balance sheets and are looking to allocate capital in a more shareholder-friendly way. And then outside of the large global index stocks, which have driven a lot of the global market's performance over the last while, there are actually a number of interesting, more idiosyncratic opportunities which we will look to take advantage of. So in summary, we've kind of allocated the various asset classes to attractive, fair, and expensive. And what's encouraging is that in the attractive bucket, we now have SA bonds, SA equity, US bonds, and emerging market equities. So there are lots of areas in which we can find attractive investment opportunities and at the same time still manage to build a diversified, robust portfolio. So these are the changes to the asset allocation that have happened over the last 9 months. I think the big change there to note is the increase in South African bonds from 30 to 40%. That is largely an increase in our inflation-linked bond exposure, which now totals about 10%. But as I have already mentioned, the portfolio is nicely diversified. We have approximately half the portfolio in growth assets and half in yield assets. The yield on the fund is just under 8%, which should provide a nice underpin to returns, and we are nicely diversified across geographies and asset classes. So the recent actions have included taking profits on risk assets that have moved higher. We've actually been adding hedges to both our South African equity and offshore equity exposure. In fact, the VIX, which measures volatility in the US market, has been very, very low, which has meant that the cost of actually hedging some of your downside has been cheap, and we've taken advantage of that. We've been increasing our bond exposure both in SA and offshore. We've tried to keep the portfolio diversified, and especially with regards to the underlying securities in the portfolio, we've been focusing on businesses with strong balance sheets and good business models, because we think after an era of very easy money, companies with weak balance sheets profits have been flattered. But if you have cash on hand and the market wobbles, you can always buy back your shares. And if interest rates stay high, you should also benefit from the endowment effect of earning higher interest on your cash balance. Thank you for your time.